Most traders don't lose money because they're wrong. They lose money because they're in a hurry. They rush into trades. They rush out of trades. They rush decisions that should never be rushed. They feel late, behind, pressured, like the market is about to leave without them. So they click, they adjust, they interfere. And then they wonder why trading feels exhausting, stressful, and impossible to get right. They call it bad luck. They call it manipulation. They call it volatility. They blame news, spreads, algorithms, or their broker. Anything except the one habit quietly destroying their consistency. Meanwhile, a small group of traders operate at a completely different pace. Same markets, same charts, same sessions, same opportunities. But they look calm, almost detached. They trade less, wait more, and somehow end up more consistent. Not because they know more, but because they move slower. This is the part most traders don't want to hear. Speed feels productive. Speed feels professional. Speed feels like control. Slowing down feels uncomfortable, risky, even lazy, like you're missing something important, like you're not doing your job. But here's the paradox. The traders who last the longest, lose the least, and grow the most aren't the fastest. They're the slowest. They wait longer. They decide later. They act only when things are clear. There's a simple rule behind this that changes how you see trading entirely. Most traders never learn it because it goes against every instinct they have. But once you see it, you can't unsee it. And trading stops feeling like a race you're always losing. Part 2. Why speed feels right and quietly ruins you. Speed feels natural because everything else in your life rewards it. You reply faster. You look sharper. You work faster. You're seen as productive. You make quick decisions. You're confident. From school to work to business, speed is praised. Hesitation looks like weakness. Waiting looks like uncertainty. So when traders come to the markets, they bring the same conditioning with them. The problem is the market doesn't work like the rest of life. It doesn't reward urgency. It doesn't care how quickly you react. And it definitely doesn't pay you for being busy. But your brain doesn't know that. All it knows is that when things feel uncertain, the safest response is to act. Fast trading gives the illusion of control. Clicking buttons feels like doing something. Adjusting stops feels responsible. Closing trades early feels like damage control. Even overtrading feels better than sitting still, because at least you're involved. At least you're not missing out. Speed soothes anxiety in the short term, even if it destroys results in the long term. There's also a chemical element most traders never acknowledge. Fast trading is stimulating. Every candle, every tick, every entry gives a small hit of excitement. Your brain starts associating activity with progress. Waiting becomes boring. Boredom feels wrong. So you manufacture reasons to trade. You convince yourself the setup is close enough. You tell yourself you'll manage it actively. And before you realize it, you're trading to feel engaged, not because the trade is actually there. This is why slowing down feels unsafe. When you wait, you're alone with uncertainty. There's no button to press, no action to take, no immediate relief. Your mind fills the gap with fear. What if this was the move? What if it runs without you? What if this is the one you miss? Speed becomes a way to escape those thoughts. Most traders don't realize they're not trading the market. They're trading their discomfort with waiting. This is where two types of traders start to separate. One trades fast. He's always scanning, always adjusting, always reacting. He feels busy all day, but ends most weeks confused about what actually worked. The other trades slowly. He watches more than he acts. He lets trades go without him. He sits through long stretches of nothing happening. From the outside, it looks like he's doing less. In reality, he's filtering more. The fast trader feels in control but isn't. The slow trader feels uncomfortable but is. What makes this worse is that speed is easy to justify. You can always find a reason to act. A level breaks. A candle closes. Volume spikes. News hits. There's always something happening in the market. The problem isn't the lack of signals. It's the lack of restraint. Over time, fast trading creates a dangerous loop. More trades lead to more feedback. More feedback creates more emotion. More emotion leads to more interference. You start managing trades instead of executing them. You move stops to avoid being wrong. You take profits early to feel relief. You cut winners short and let losers breathe, not because it's logical, but because it feels safer in the moment. Slowing down breaks that loop, which is why it feels so threatening. When you slow down, you remove the emotional noise. You give trades space to work or fail on their own. You stop negotiating with price. And without realizing it, you start seeing the market more clearly. Most traders think they need to speed up to catch opportunities. In reality, speed is what keeps them blind. They're so focused on reacting that they never let clarity form. They confuse movement with meaning and activity with progress. This is why telling traders to just be patient never works. Patience sounds passive. It sounds like doing nothing. But what's actually happening is much deeper. Slowing down forces you to confront uncertainty without trying to escape it. And until you understand that, speed will always feel like the safer option. But it isn't. Part 3. The slow trading rule. The shift doesn't start with trading less. It starts with seeing the market differently. Most traders believe their job is to react. Price moves, they respond. Something changes, they adjust. They treat speed as skill and hesitation as failure. That mindset alone keeps them trapped. The slow trading rule flips that completely. It says, your job is not to react quickly. Your job is to wait until reacting becomes obvious. Not comfortable, not exciting, obvious. Professional traders don't rush decisions because they don't feel pressure to act. They understand something most traders never internalize. The market does not reward the first person to move. It rewards the person who moves at the right time. Acting early feels smart. Acting late feels wrong. But acting early is how you absorb uncertainty. Acting late, when clarity forms, is how you reduce it. Slowing down doesn't mean hesitating once you're in a trade. It means delaying the decision to trade in the first place. Letting price show its hand. Letting levels confirm. Letting conditions line up without forcing them. The slow trading rule is simple. If you feel rushed, you're early. If you feel calm, you're aligned. This is where the real shifts begin. The first shift is from reacting to allowing. Price does not need your immediate opinion. Most movements mean nothing. Letting candles form, letting structure develop, letting noise pass is not weakness. It's filtration. When you stop reacting to every move, what remains starts to matter more. The second shift is from activity to selectivity. Slower traders make fewer decisions, not because they lack confidence, but because they protect it. Every decision costs mental energy. Every trade carries emotional weight. When you trade less, each decision gets cleaner. You stop spreading focus across marginal setups and start reserving it for the ones that actually fit. The third shift is from fear of missing out to trust in abundance. Fast traders act because they believe opportunities are rare. Slow traders wait because they know they're endless. The market will open tomorrow. There will be another setup. There will always be another chance. Your capital and your clarity are the scarce resources, not trades. Then comes the most uncomfortable shift of all. Patience stops being passive and becomes a skill. Waiting is no longer downtime. It's active discipline. It's the willingness to sit with uncertainty without trying to fix it. To watch price approach a level and still do nothing. To let a trade go without chasing it. To accept that doing nothing is sometimes the most accurate decision you can make. This is why the slow trading rule feels unnatural at first. It removes the emotional escape routes. You can't hide behind activity. You can't mask doubt with action. You either wait for alignment or you don't trade. There's no middle ground. When traders apply this rule properly, something unexpected happens. The market starts to look quieter, not because it changed, but because they did. The constant urgency fades. The need to interfere weakens. Trades stop feeling personal. They either meet the conditions or they don't. Slowing down doesn't make you late. It makes you precise. And precision is what most traders have been missing all along. Part 4. When slow becomes natural. The effect of slowing down doesn't show up as a sudden breakthrough. It shows up quietly, in the way trading starts to feel different. One trader I worked with used to take 20 or 30 trades a day. Constant entries, constant management, constant stress. He felt productive, but his results barely moved. Some weeks green, some weeks red. mostly flat. More effort never translated into consistency. When he applied the slow trading rule, nothing about his strategy changed. Same market, same setup, same risk. The only change was this: he limited himself to waiting. Some days he took one trade, some days none. At first it felt wrong, like he was wasting time, like he wasn't doing enough. But within weeks, his execution improved. He stopped second-guessing entries. He stopped interfering with trades. His losses became cleaner. His winners were allowed to run. His results didn't explode. They stabilized. And stability was something he'd never had before. This is what slow trading actually looks like. Long periods of watching. Short moments of decisive action. No urgency. No chasing. No constant adjustment. You wait. You act. You step back. Most of the day is uneventful. And that's the point. At this stage, the identity shift happens almost on its own. Fast traders see themselves as people who need to be involved. Slow traders see themselves as rule executors. Their confidence doesn't come from being active. It comes from being aligned. A losing trade doesn't shake them because they didn't break character. A winning trade doesn't inflate them because they didn't do anything special. They followed the rule and let probability play out. This is where trading becomes boring. And boring is not an insult. Boring means controlled. Boring means repeatable. Boring means you're no longer emotionally entangled with every price movement. The traders who fail are looking for excitement. The traders who last are looking for clarity. The market doesn't reward speed. It never has. It rewards patience, selectivity, and the ability to wait without forcing meaning where there is none. You don't need to be faster than the market. You need to move at its pace, not yours. That's the real power of the slow trading rule. It doesn't make you smarter. It doesn't give you an edge you didn't already have. It removes the behaviors that were quietly working against you. And when those behaviors disappear, trading stops feeling like a battle and starts feeling like a process. You can keep trading fast, staying busy, staying stimulated, staying stressed. Or you can slow down, filter harder, act less, and let the market come to you. The opportunity will always be there. The question is whether you'll still have the clarity and capital to take it. Keep following the channel as we share more insights, trading stories, and trading motivation tips in future videos.